Welcome back to the deep dive. So today we're going to really get into a fascinating document. It's the Morgan Stanley March 2013 letter to shareholders, written by the CEO, James Gorman.
Yeah, this letter is, well, it's more than just numbers. It really captures a moment in time, a pivot point. They called it a thorough reassessment after all the financial chaos.
Right, the upheavals.
Exactly. And the aim was to lay out how they were shifting towards more consistent, sustainable profitability. It's their story of transformation.
It really sounds like a fundamental rethink. I mean, for a firm that's been around nearly 80 years, pausing to ask, what do we do? How? What results? That's significant.
It is. They weren't just tinkering.
Okay, so our mission today is to unpack that journey, see what strategic shifts really mattered, and, what you can take away from it.
Sounds good.
Let's start where they started, which I found interesting looking back at their history, their origins during the Great Depression.
Yeah, that framing is important. They anchor their purpose in that history, helping companies lead the way out of stagnation back then.
So connecting the past to the present strategy.
Precisely. So their activities today, advising, originating, trading, managing capital, it's all viewed through that lens. And the key phrase they use is doing this across our organization for the client. It's about integration.
And they underpin this with 4 core values. Now, values can sometimes sound a bit like, corporate speak.
Sure.
But given this was 2013, post-crisis, emphasizing them feels pretty strategic. First one, putting clients first. Standard enough.
Right, but the second one, I think, is quite telling for that era. Doing the right thing. And that included integrity, sure, but also thinking like an owner for long-term value.
Kind of a reaction to the short-termism that got banks into trouble.
Exactly. Then it's leading with exceptional ideas and giving back. They state pretty clearly this idea of doing first-class business in a first-class way since 35.
So reaffirming that commitment to, 57,000 employees worldwide was probably a big part of rebuilding trust.
Absolutely critical, I'd say, both internally and externally.
Okay, so let's pivot to how this translated into performance in 2012. Investment banking, where were they putting their chips? Where were they winning?
Well, they definitely doubled down on their core investment banking franchise, and it worked. Especially, they mention in debt underwriting.
Okay.
They'd invested there for years, and in 2012, it paid off with higher market share and, critically, higher wallet share.
Right. Let's just quickly unpack wallet share. That means getting a bigger slice of a specific client's total banking business, doesn't it?
Exactly. If a company spends, say, $100 million on banking fees, what percentage of that goes to Morgan Stanley? A higher wallet share means you're becoming their go-to bank.
Got it. And this wasn't just U.S. focused.
No, not at all. They highlight helping European countries navigate the euro crisis, raising capital, restructuring sovereign debt. That's pretty high-level stuff.
Yeah, that's advising governments, not just companies.
And the rankings sort of back that up. No 1 in global IPOs, no 2 in global M&A advisory, no 2 in global equity offerings. Still a powerhouse.
Okay. What about the other side of the house, sales and trading?
This is where you really see the strategic shift happening. Equity sales and trading, still a top franchise, very strong.
What?
But fixed income and commodities, that was being, reshaped. They were concentrating efforts on specific growth areas like interest rates and foreign exchange products.
And pulling back elsewhere.
Deliberately. It wasn't just about cutting risk, although that was part of it. It was also, I think, a bet on where regulation was heading.
How so?
They explicitly say they expected markets to become more client-centric, less dependent on balance sheets, and heavily electronic.
So leaning into electronic trading platforms.
Right. They mentioned significant volume growth there in 2012. It's basically signaling. We're focusing on efficient, tech-driven, capital-light business models, not the old-style capital-heavy prop trading.
That tech investment seems like a really crucial piece of the strategy then.
I think so. Very forward-looking.
Okay, this naturally leads us to maybe the biggest piece, consolidating wealth management. This seems central to their whole stability argument.
Oh, absolutely. Getting full ownership of the wealth management JV, which became Morgan Stanley Wealth Management, that was huge. Nailing down the cost, the timeline, finishing the Smith-Barney integration, a massive undertaking for 2012.
And why was this such a big deal strategically?
Because it provided the counterbalance to the inherent volatility in institutional trading. They spell out the benefits pretty clearly in the letter.
Which were?
3 main things. Sizable and stable revenues, think fees, not trading profits. a substantial deposit base, which helps funding, and crucially, low relative capital usage.
Right, doesn't tie up as much capital as the trading businesses.
Exactly. It fundamentally shifted the firm's overall risk profile. And the numbers showed it was working.
What were the key metrics there?
Client assets grew 8% to a whopping $1.8 trillion. That scale just provides a bedrock of fee income.
$1.8 trillion. Wow.
Yeah. And profitability was climbing. They hit a 17% pre-tax margin in wealth management in the last quarter of 2012, the highest since the JV began.
Even the full year 12% margin adds a lot of stability, I imagine.
For sure. Plus, the investment management division, MSM, also grew assets, up 18% to $338 billion. Yeah. So scale was translating into efficient growth.
It proved they could actually integrate and run this massive wealth manager effectively.
Right. It wasn't just big. It was becoming a profitable defensive asset.
Okay, let's switch gears a bit to risk and efficiency. Post-crisis, every bank was obsessed with this. Fortifying the balance sheet was paramount. And that brings us to risk-weighted assets, or RWAs.
Ah, yes, RWA. We should probably explain that briefly.
Please do.
Okay, so think of RWAs as basically all the bank's assets, loans, trades, everything but adjusted for how risky regulators think they are. Cash is low risk, so low RWA. Complex derivatives, high risk, high RWA.
And the rules post-crisis meant banks had to hold way more capital against those high-risk assets, right?
Precisely. So if you can cut your RWAs, especially the high-risk stuff, you need less capital overall. And Morgan Stanley went after this aggressively.
How aggressively?
They cut RWAs by more than 40% for the peak, which was around $500 billion. That's a reduction of over $200 billion in risk-weighted exposure.
Wow.
And they highlight that they finished these reductions a full year ahead of schedule. That's a huge accomplishment, both financially and from a regulatory perspective.
So, okay, it meets regulatory demands. But strategically, why does slashing RWAs matter so much? What does it unlock?
It frees up capital. Capital that was previously tied up supporting risky assets can now be used for, as they put it, earning more attractive returns elsewhere, or ultimately be returned to shareholders.
So it's generating firepower for growth or returns, moving from defense to offense.
That's a good way to put it. And they did this while still maintaining, what they felt was an appropriately sized fixed income business. It wasn't just about shutting things down.
And this de-risking went hand in hand with cost cutting, right?
Oh, yeah. Expenses were down $500 million in 2012, even after making necessary investments.
But that involved some tough decisions, I imagine.
It did. The letter mentions reducing headcount by more than 6,000 people since late 2011. That shows a real willingness to resize the firm for the new reality.
So less risk, lower costs. What did that do for their overall capital strength?
It strengthened it significantly. Their Basel I Tier 1 common ratio hit 14.6% at the end of 2012. That was up sharply from 12.6% the year before.
And just remind us, that ratio is basically a key measure of a bank's safety cushion.
Exactly. How much high-quality capital they have to absorb potential losses. 14.6% back then was considered exceptionally strong. It told the market they were very well capitalized.
Okay.
Plus, they had a big liquidity buffer, $182 billion in unencumbered reserves.
Right.
Basically readily available cash. So strong capital, plenty of liquidity.
All right, so the balance sheet is strong, stable. The next logical step is, how do you drive higher returns from that position of strength? The letter talks a lot about collaboration.
Yes, this was about leveraging the whole firm. They felt they were only scratching the surface of the potential synergies between the big institutional business and the huge wealth management arm.
Breaking down silos.
Right. They launched over 35 initiatives specifically aimed at boosting collaboration.
Okay, 35 initiatives sounds good, but what does that actually mean? How do you make, say, an investment banker work closely with a financial advisor? Different worlds, different cultures.
It required systemic changes. They talk about a more coordinated and systematized approach to senior relationship management.
Meaning?
Well, imagine a top banker is advising a CEO on a major deal. The new system would ensure that banker coordinates with the Morgan Stanley advisor who handles that same CEO's personal wealth.
So joining up the institutional relationship with the private client relationship.
Exactly. Systematically identifying those overlaps, top institutional clients who are also actual or potential major wealth management clients. It's cross-selling, but on a strategic, integrated level, capturing more of that total wallet, institutional and personal.
And they felt this was a unique advantage for them, given the scale of both sides.
They did. Because they now own the whole wealth management platform and had top-tier institutional capabilities. Leveraging that internal network became a key competitive play.
So, wrapping up the strategy, full ownership of wealth management for stability, RWA cuts, freeing up capital, hitting profit targets in wealth management, and then driving growth through this collaboration. Seems like a pretty clear plan.
It is. It's a coherent story moving from cleanup and de-risking to optimization and growth. And, the markets seem to finally get it.
Yeah, the letter mentions that shift in market sentiment in late 2012. How did that show up?
The most telling sign was that their credit spreads tightened dramatically,
Okay, meaning?
meaning the cost for Morgan Stanley to borrow money went down. Investors saw them as less risky, more stable. The perceived chance of them defaulting decreased significantly. That's huge validation for the market.
So the market was acknowledging the stronger balance sheet and the clearer strategy.
It certainly looks that way. Market acknowledgement was starting to catch up with the internal progress.
So looking back at this deep dive into the 2013 letter, it really paints a picture of a firm, laser-focused on stability, efficiency, getting the benefits of scale, and then connecting the dots internally.
Yeah, it's a powerful story of transformation under intense pressure. The path to better profitability clearly involved getting leaner, safer, and smarter about leveraging all parts of the business.
Which brings us to our final thought for you to reflect on. If these massive, long-established financial firms need to keep revisiting their core mission, their fundamental values, after major market shocks and regulatory shifts, what does that really tell us? What does it suggest about that inherent tension between, say, maximizing short-term shareholder value and ensuring long-term institutional stability and maybe ethical conduct? Is that relentless drive for growth always compatible with responsible risk management? Something to think about next time you look at the strategy of a major global bank.